Well, hello, everybody. It's time for Tax Talk with the Real Estate Guys, how you can pay less tax legally, ethically, and pretty easily. And specifically, we're talking today about the Trump's tax tactics. How is it that a guy can make lots of money and pay zero tax? Now, I think we should start off by saying that this is not political in any way. The guy we're talking about, Donald Trump, happens to be president of the United States, and that's why it's in the news. But for a long time, he's been paying little in tax. Is he getting away with some shenanigans? What's the deal? That's what we're here to talk about. I'm Robert Helms, host of the Real Estate Guys radio program. Let's say hi to our co-host, financial strategist, Russell Gray.
Hey, Robert. Hey, everybody.
So what we really wanted to figure out today is how does somebody make lots and lots of money and pay nothing hardly in tax? That can't be right, can it? Well, we have opinions about that, but even more importantly, we have a gentleman who knows a ton about tax joining us today. He is the best-selling author of the book Tax-Free Wealth. He's a certified public accountant, and he's the Rich Dad advisor for taxes. Let's say hi to our friend Tom Wheelwright. Hey, Tom.
Hey, Robert. Hey, Russ. Good to see you guys.
It is always good to see you, my friend, and tax time is a good time. I know you love taxes. You love taxes because of, as you've explained to us, most of the tax law are incentives, deductions, ways we can save in tax. And so when you say the word tax, people freak out. They're like, oh, I don't want to pay tax. And at some level, people don't want to pay tax. But I think maybe to start with is the understanding of why there is tax in the first place. This concept that I'm going to put part of my income towards paying tax so that the things that all of the community uses can be paid for. Can you just talk about the general idea behind taxation in places like the United States?
Yeah, so it's interesting because it's evolved over the years, right? For a long time, we had no income tax. In fact, till 1914, it was illegal to have an income tax in the United States until we had the 16th Amendment, right? So it's actually a fairly new phenomenon in the United States to have an income tax. I remember the U.S. was formed as a result of a tax revolt, right? The Boston Tea Party was a tax revolt, and that's really what started the revolution, was that tax revolt. So it's interesting that Americans have historically not liked tax, and they've actually been against taxes. And it's only in recent history that we've seen this whole idea of more and more taxes to do more and more, right? The question is, how much do you want the government to do? And how do you want them to do it? I mean, that's really what the question comes down to. And then the government's point of view is, what do we want to do? And do we want to do it? Or do we want to encourage our citizens to do it for us? And actually, your point about people hate paying taxes, actually the whole reason we have the tax law the way it is. Because the government figured out about 60 years ago now, I mean, it's really when we started seeing this with the investment tax credit in the 60s, that people hate paying tax, and a little bit of incentive, a little bit of encouragement would get them to do things that the government wanted them to do. And that's where the tax law came from in its current form. Prior to 1944, wage earners didn't pay tax at all. It was only the rich who paid tax. Now it's completely flip-flopped, where it's the wage earners who pay the tax and the rich don't pay tax. So that's also an interesting evolution, but it comes down to, what's the tax policy of a country? What are they trying to do? And they tend to use taxes as basically the hammer, the encouragement to get it done.
And this is a big paradigm. When you start to think of tax and tax deductions as incentive for behavior, it's not punitive. It's not, oh, you have to give a certain amount to your government. There are things that cost money. And part of the way we get that paid is through tax contribution. Now, that maybe used to be more important than it is today, and I'm sure we'll get into that. But the basic idea is, depending on how you earn your money, tax changes. So I think a place to start, Tom, might be the cash flow quadrant and taking us through the different ways people earn money and how different income earners are taxed differently.
Right. And then what the other side of this is, it's really a question of, it's not a question of, are people paying tax? It's a question of which people are paying tax.
Right.
Right. So if you look at, because let's look, all income's taxed to somebody. The question is, who's it taxed to? Right? All income is taxed. to somebody, the question is who it's taxed to. So if you look at how you make money, the average person makes all their money as an employee, or most of their money as an employee. Yeah, they save some money and they may invest in the stock market, et cetera, and they may earn a little bit in investments, but for the most part, they're making 98% of their money or 95% of their money as an employee. Then they get really good at being an employee. They decide, I want to own my job. I want my own job. I don't want a boss. I can make more money if I'm self-employed. So we now have the self-employed, the superstars. You know, these are the athletes, the superstars, the doctors, the lawyers, and the accountants. And here's where we are, right? Then we have somebody goes, well, wait a minute. I don't want to just be a small-time employee business. I want to be a big business. I want to have 500, 1,000, 10,000 employees, or like in the case of you guys in the real estate world, you want to be a professional investor, right? You want to make your money as an investor, not as per se a business owner, or you may make some of your money as a business owner or an employee and then make the rest of it as a professional investor. There's no reason that you have to be in only one quadrant. I can tell you right now, I'm in 3 of these quadrants right now, working towards the 4th. I mean, so I love the quadrants. I love them all.
Well, that's a great point. And before you make the next point, which I think will bring to light a lot of the differences, the 3 of us were invited to attend a really awesome event many years ago that our mutual friend Robert Kiyosaki put on about the quadrant, and specifically how to be a great E or a great S or a great B. And there's this misnomer that, well, you need to be an investor or a business owner. And that's not true. How you earn your money depends on what you do to live, thrive, and survive, the kind of lifestyle you want to have. So none of these are wrong. None of these are bad. They're taxed differently.
They are. So here's what's happened since 1944. Here's the evolution of the tax law. Now, in most countries, including the United States, if you earn a really good, I mean, I'm talking about really good salary, you're going to probably pay 40% of that in tax. If you own your business, you get extra schooling, for example, you actually get to pay more tax. Because what's really going on is you're not just paying the employee's share of the tax. Remember, it's who pays the tax. The employer is splitting the tax with the employee here. Here, you're both the employer and the employee, so you're paying all the tax. So again, it's who's paying the tax.
And this is a point a lot of employees don't understand. They see their paycheck and they have their gross income and there's all those deductions. Well, part of the deductions that were taken out of the employee's check are also matched by the employer, and some employers even have additional tax they pay. So it might seem strange that a self-employed person would pay more tax, but it's because they're playing both sides.
Exactly. If you look at the big business, that all of a sudden drops. Now, again, as I said, somebody's paying the tax. Who's paying the tax here? Well, a big business has 500 or 1,000 employees. So the employees are paying the tax. The business owner is not. Okay. So that's what happens here. It's just who's paying the tax. Tax is still being paid. Okay. But it's being paid by the employee. In the investor realm, this number can be 0. Okay. Now, in this case, it may be who pays the tax, but it's also when the tax is paid. Okay. So eventually, I was on Neil Cavuto's show on Fox last week, and he said, well, so eventually you pay the tax. I said, yeah, except when you die, it can go away. And he said, well, let's hope you can get rid of it some other way than dying. I'm going, that was pretty good. That was a pretty good line. But the reality is professional investors, they're in a special group. Okay. They're not like business owners that are sharing the tax here. Professional investors can actually get to a point where they're not paying tax and they never pay tax and nobody pays that tax. So they're in a unique, the I quadrant is a unique place to live, because it's the only place where you can pay 0 tax now and 0 tax in the future. You see, Amazon and Tesla, they paid 0 tax for years and years and years, right? But now Amazon's starting to pay tax. We're going to start seeing Tesla in the next few years starting to pay tax because eventually they will pay tax, right? The professional investor never has to pay tax.
Well, Tom, this gets back to your premise at the beginning and something you've taught us for years, which is that if you read it, the country's tax code, whatever country that is, you can see what the government wants people to do. It encourages behavior through tax incentives. So if I understand this right, someone who's an investor, say in real estate, I don't know, like Donald Trump, can legally pay very, very little in tax. How does that work?
Okay, so what we have to look at is the actual incentives, right? And the whole point of tax-free wealth is to show you where the different incentives are. And the biggest incentive, actually in most countries, there are two places that every country gives incentives. One is business and the other is real estate. Okay, those are the two places you can count on. I've been all over the world with Robert Kiyosaki, and every time I look at the tax law, and the reality is that the tax laws are pretty similar from country to country. Now, they're not going to be similar when it comes to energy because most countries don't let private individuals own their energy. They're owned by the country. And they may not be the same in other things, but when it comes to business and real estate, they're very, very similar. Now, of course, in this country, now I'm old enough to remember Ronald Reagan. I was in Washington, D.C. when Ronald Reagan passed his big bill. And when Ronald Reagan first came to the presidency, he immediately gave tax benefits to real estate. Okay, just like we're going to talk about here. He gave massive tax benefits to real estate and then 6 years later took them away. Okay, so it was very fascinating because he flip-flopped completely on real estate. So here's what happens. We have what I call the magic, it's chapter 7 of tax-free wealth. The magic of depreciation. And this is what makes real estate different from everything else, okay? This is real estate, if let's say you buy a car, okay, and you use it in your business, you're going to get a depreciation deduction for your business because you own the car, let's say it lasts 5 years, you're going to deduct 20% a year. That's depreciation. But at the end of 5 years, that car's not going to be worth very much.
Right.
Okay. The difference with real estate is, and by the way, we get to do the same thing in oil and gas, the same thing in business equipment. We can do the same thing, right? The difference with real estate is where oil and gas, you do it, that's a depleting resource. So your actual value is going down, not up. In real estate, you can actually have depreciation deductions over a period of time and the value goes up. And when you sell it, you don't have to pay tax. And so real estate is very, very, very highly favored. It's the most highly favored investment in the US right now, and actually has been for several years. So basically what happens is, if you think about when you buy a piece of real estate, you're really buying 4 things, right? You're buying land. Even the IRS knows land doesn't wear out, right? So no deduction there, that's 0. You have building. Does it wear out? Yeah, buildings wear out eventually, unless you're in Italy. They tend to wear out over, maybe 25 to 40 years is what the IRS says. So You're gonna get a little bit here. Let's say you're in residential real estate, that's about 3.6% per year, okay? Because that's 27 and a half years for whatever reason, they made that up. Under Ronald Reagan, it was 18 years. Okay, so just to give you an example, it's gone, that percentage has gone down. Then we have this next one, we have what we call land improvements. And land improvements are things like your outdoor lighting, your driveways, your fencing. I mean, all those things that, even landscaping. And you think, how long does that really last? Well, in Arizona, where I live, landscaping really never lasts through the summer, but for the most part, that's why there's so many rocks everywhere. But land improvements, what the IRS said is, well, typically they're going to last about 15 years. So we're going to call that about 7%, right? And then we have you really have everything that's in the building, right? So we'll call that the contents of the building. And the IRS said, well, you know what? You're going to replace that every few years. We know carpet gets worn out, especially when you have tenants. Your carpet in your home tends to last longer than the carpet in a rental. Don't know why.
Who knows why? But yes, you're right.
It's a mystery. But typically, so we're going to say about 20%, a year. Well, so if you bought a property for $1 million, land is probably only 20% of that, right? And buildings probably 50%, right? And then you have land improvements probably about 10, and then your content's about 20%, right? So you think about it, only 20% is not giving you a deduction. That's basically your down payment, right? So your down payment, you don't get a deduction for, but all the money the bank put in, the building, the land improvements, and the contents, you get to a write-off every year, even though you're making money. So if you look at Trump, which is really interesting. So according to the New York Times, he took his money from The Apprentice, $400 and some odd million, pretty impressive number actually, and he put that all into golf courses, is according to the New York Times. Okay, well, if you took all that money and you put it in the golf courses, you're going to have a whole lot of depreciation, because we also know President Trump, as he's the self-proclaimed king of debt, which means that he uses a lot of debt. Well, here's the other magic of real estate. You don't get a tax deduction just for the money you put in. You get a tax deduction for all the money the bank put in. So if you've got a ratio of $1 of investment to $4 of loans, that's a total of 5. 1 plus 4 is 5, right? At least my accountant mine says it is. And so you have 5 times the tax deduction as if you invested all your own money. 5 times the tax deduction. And that's very clearly what Donald Trump did. And interestingly enough, when you read the New York Times article, which I of course read the whole thing because I knew I was going to get questions on it, they actually do say that, right? They do say that. I mean, they imply a lot of other things going on, but they do say this. Now so this is why real estate, this is why you can do that, because depreciation, think about this, it's not money out of your pocket, right? I mean, this is just because the bank put the money in, you didn't, and the tenants are paying the bank back, you're not. So this isn't money out of your pocket, it's out of the bank's pocket, and yet you're getting this big tax deduction. So could Trump, I mean, I don't know, I haven't seen his tax returns, but really could President Trump actually pay 0 in tax and still make millions of dollars? Yeah, absolutely. It's not that hard.
Well, and this is what people, I think, have a hard time getting their mind around, because what you just explained was not that complicated, and it makes sense. We're going to get, you think about the depreciation deduction. It's not actual money that's coming out of your pocket, so we call it a phantom expense. We get credit for spending the money. But there are situations, and we've been in this situation, you've been in this situation, where we have what looks like a loss from a tax point of view. On paper, it's a loss because of the deduction, and it could be because of depletion and other tax incentives. But at the end of the day, we're actually making money. So this isn't some nefarious thing that, oh no, it's these tax returns show that anybody, Trump, whoever, is hiding or shielding. What he's doing is using the tax law for the reason it was written.
Yeah, so let's look at it this way. So we're all partners with the government, right? We're business partners with the government. We don't
like it or not, yes.
Like it or not, if you're a resident of this country or you're a citizen of this country, you are a partner with the government. And here's the great thing about the tax law. You get to choose what kind of partner you are, right? You can be a silent partner and have the money just taken out of your paycheck. That's a silent partner. Every paycheck you get withholding taken out, you get FICA taken out. That is a silent partner. The government's fine with that. They get 40%. They're good. Okay. You could be a silent partner down here and pay 60%. The government's even happier with that. I mean, basically, by the way, the amount of tax that's paid is the same here as here, right? It's just that here the business is paying some of the tax and the employee's paying some of the tax. But understand that the amount of tax, it's still about 60%. It's who's paying it. right? Now, all that's going on here is, wait a minute, I could be a different kind of a partner. I could be a big business, okay, where I'm employing lots of people because the government wants jobs is, you think jobs are like job number one of the government from an economic standpoint, right? They don't, because otherwise you have civil unrest and you have unemployment and you have to do $1 trillion rescue bills for the unemployed, right? I mean, we've seen it this year. The government doesn't like unemployment. They hate unemployment. And so your choice is the government can employ the people. We actually saw a lot of that in the Obama era. Okay. We saw Washington, D.C. just boom. I know you've got a partner who did fabulously well in Washington, D.C. because of that boom. And then the government, employed those people. Look at the Soviet Union. Everybody was employed by the government, right? So you can have the government do it or you can have business do it. Historically in this country and most Western countries, we've said, let's let independent entrepreneurs do it. So we'll let them employ people instead of us having to employ them. And then for investors, again, the question is, who does the work? Do we have the government build housing? Now, if you've ever seen government housing, probably best if they stay out of that. All right. There's not one single thing that we've ever seen the government do better than private industry. Not in the history of the world. I mean, people would say, 10 years ago, people would say, well, what about the, astronauts and going to the moon and everything? I'm going, okay, yeah, but now look at SpaceX.
Right.
The government has said, we're not even going to do it because SpaceX can do it better. They can land their rocket back on the pad in the ocean. I mean, seriously, the government could never do that, right? So what's going on here is they're just saying, if you're this kind of a partner, we're going to let you not pay tax at all. But it's really, what kind of a partner are you? How active are you as a partner? Are you a silent partner? Are you an active partner? And it really comes to being that simple.
Yeah, I love that explanation because you do have a choice. And people that just go to work for somebody else and get a paycheck and have a big chunk taken out and complain about taxes, they don't understand when they hear this guy, made all this money and didn't pay any tax. But you brought up earlier that the two things that are consistent in every country are business and real estate. That's because business creates jobs, real estate creates housing, two things that every country needs, and they'd rather not do it themselves, to your point. So part of the big question, you hear and again, this is just the news cycle and because it's a presidential year, but Trump paid $750, and then you hear Trump say, no, I paid millions in taxes. Can both those things be true? Where did he pay millions of taxes on the quadrant?
Good question. All I can do is speculate, right? I haven't seen his tax returns, but it's very possible he paid him here.
That's what I'm thinking. He's got a lot of employees and a lot of different businesses.
So look at it over here. Here you have Biden-Harris, right? Actually, let's put Biden up there. We'll put Harris down here because her money comes from her husband, who's he's a lawyer, right? So he's down here. So you look at his tax bill, and it's like huge numbers, right? If you look at the Harris tax bill, they released their tax returns. I'm going, oh my heavens! I mean, it just took my breath away to see how much tax those guys are paying. And then over here, you have Trump. Right? And he's here and he's here. And what he typically does, now he was also here, right? This is The Apprentice right here. That's The Apprentice. He was Superstar. Right. And so what he did was he took the money here, put it here, took the money here, put it here, took the money from here even and put it here, right? And so he's got this little triangle going on. And guess what's over here? Nothing.
Right.
Jeff Bezos pays what, $1 is how much he pays himself. Well, why does he pay? You ever ask yourself, why does Jeff Bezos only pay himself $1? Duh, it's because of taxes. Right? Why didn't Donald Trump take a paycheck when he moved into the White House? Are you kidding? Way better to get the money at Mar-a-Lago than to get the money from a paycheck from the U.S. government, right? I mean, where do you want your money? I'd rather get it at Mar-a-Lago. I get all the depreciation deductions of Mar-a-Lago. So this is absolutely what's happening. Now, this could his business have been a corporation that paid a bunch of taxes? Absolutely. Would it have showed up on his personal tax return? No, because the business doesn't show up. That business may not have shown up on the personal tax return. So it's very possible that he paid a bunch of taxes here, but he would have paid a very low rate because big business pays the lower rates.
Yeah, good stuff. So I guess the big fundamental question, one, we wanted to kind of pick your brain on, is this possible and how does a guy who makes a lot of money pay little taxes? Well, obviously a man who's written a book called Tax-Free Wealth knows a few things about that. So the big question, and it's a loaded question, is this just for millionaires and billionaires? Or can average people who want to be in real estate or business owners, how can they take advantage of some of these tax incentives and pay less in tax?
So here's the great thing about the tax law. This word, of all the words that describe the tax law, I would use this word first. The tax law is fair. And the reason it's fair is because anybody can choose to make their money any way they want. This is, to me, it's the great thing about the United States of America. It's really one of the few places where you have so many choices about how to make money, right? I mean, we can make money in energy. We have friends, right, that make a ton of money in energy. Elon Musk makes a bunch of money in solar energy, and he makes money in, electric vehicles. I mean, you can make money so many different ways. All you have to do is, understand the law and then choose where do you want to make money. But it doesn't matter how big you are. Here's the thing about this. These people, yeah, they may pay 60%. They don't have to pay 60%. They can do what these guys do and pay 20%. They have exactly the same laws because the tax law is fair, because under the Constitution, we have what's called the Equal Protection Clause that requires everybody to be treated equally if they're in the same circumstance. So what I like to say, and you've heard me say it a dozen times before, if you want to change your tax, you've got to change your facts. Right? Anybody can do it at any level. You can buy a $20,000 house in the ghetto, and you can get this. Okay, you can buy a $200 million commercial building, Trump Tower, and you can get this, right? So you can choose. It's just how many zeros you have on it, but the tax law is fundamentally fair.
Well, that's a great way to think about it, Tom, right? If you think about it, and this was really helpful. These are big round numbers you use, 40%, 60%, 20%. But think about a blended rate. If you're an employee and you're paying a lot in tax, and all of a sudden you say, well, rather than pay tax, I'm going to buy a rental house. Well, I'm going to get some deductions, and some of those things are going to be better deductions than others, like when you do a cost segregation study, which is just going through those 4 things that you talked about and figuring out what elements of the house actually depreciate faster. And that's a way where you can change your facts. So now you still have your job. Maybe you love your job. Maybe you do a great, job and you make good money. You pay more tax on it, but you can choose to invest some of that, and now you're going to get some of these tax benefits. So if you have some of your portfolio of income, if you will, that you're paying 40% on, and some you're paying 0, well, then you're going to get this blended rate, this idea. So I think what happens is most people aren't enjoying tax, so they don't study tax. So they figure, well, you know what, if I make a lot of money, I'm going to pay a lot of tax. And what hopefully you've done for us today is prove that that's just not true.
I'm shocked. People don't like studying tax. I don't understand. To me, this is seriously, I went into tax because I'm going, what's the most difficult area in the world to understand? Albert Einstein said it was income tax. And I'm going, if Einstein thought it was complicated, I'm going, I'm in. Because what's fascinating to me is once you understand the law, is it's so practical, because you can reduce your taxes, you can build your wealth at the same time. Can I show you one more demonstration on how you do that?
Please do.
So anybody who's read Rich Dad, Poor Dad knows this diagram, because Rich Dad, Poor Dad, I finally got Robert Kiyosaki to admit that it's basically an accounting book. Okay. And his gain cash flow is an accounting gain. So here's what we have. We have our income statement, income and expense, and we have our balance sheet, assets and liabilities. Now, what do most people do? Because this is a matter of how you use your money. Okay, again, your choice, but how do you use your money? Most people, money comes in and it goes out.
Yep.
It's just spent. It's gone. I mean, think about how big of a problem we had in 2 weeks at the beginning of this pandemic. And in 2 weeks, the economy was in total collapse in 2 weeks. Seriously, you shut down for 2 weeks. People don't have enough savings to go out and spend money, et cetera, et cetera. No, we were in total collapse. Why? Because they spend it. And when they do, they pay a lot of tax, because when you use your money for personal consumption or you save your money, so use or save, you're going to pay tax on the money. Okay. So let's look at, so what do the rich do? Well, the first thing they do, the business owners, they take their money, they put it back in their business, right? They spend it on their business to produce income, right? In the meantime, they pay zero in tax, absolutely zero in tax, because we have what's called a net income, which means income minus deductions. Income, deductions, net is zero. So as long as the money's going back in the business and you're building a business, I mean, look at tech companies. They never make money. I mean, Tesla still hasn't made money. And yet it's one of the largest capitalized companies in the world. Elon Musk, having never made a dime, is one of the richest people in the world.
It's
okay,
crazy.
He doesn't pay any tax. So here's what I don't understand. President Trump, he's a crook for not paying tax. Elon Musk, he's okay. All right. He don't pay any tax, but he's okay. So, but he's not president of the United States, right? And he's, you know, and he doesn't piss people off the way, he doesn't bother people the way.
No, he bothers
Trump's.
people a completely different way.
He bothers them in a different way. That's right. Okay. I love Elon. I totally love Elon Musk. So,
how can you not? I mean, that's it, right? There's capitalism at work, and he finds a way to do something that people need, want, stand in line, get on a waiting list for, and puts that money back into his business so he's not taxed on it. To your
Not only
point,
that,
eventually he will be.
Where did he borrow the money? He borrowed it from investors and customers.
Yes.
How many thousands of people put down $1,000 on the Model 3 so that he could build the factory to build the car?
Pretty smart.
So the customers paid for the factory to build the car. Okay. So if you think about your assets, you really only have 4 different asset classes, right? You have business, you have real estate,
Our favorite.
you have paper assets, and you have commodities like agriculture and energy, right?
Yep.
So what if, instead of putting the money and spending it on current things going on in your business, what if you actually create an asset? Well, guess what? Same thing happens. Okay, so President Trump, for example, he takes the money from his earnings from apprentice, he puts it into an asset, golf courses, pays no tax, and then what happens? But then it keeps making more money. What does he do with the more money? He took the same money, he put it back into real estate, right? Paid no tax again, puts it back, and it just keeps going. Okay, this is what in chapter 24 of my book I call the velocity of money. You just keep moving the money. Well, can you do it in business? Yeah, Elon Musk has done it in business. That's what Jeff Bezos did. He did in business. He kept putting it back into the business. Could you do it in agriculture? Absolutely. Look at the big agricultural companies. A lot of them pay no tax. Why? Because they keep putting it into the fields. They keep putting it into the cattle. They keep putting it into agriculture or the oil and gas or the solar energy, right? You put the money back in, that's what happens. So when you're producing, okay, so over here, we're producing instead of saving or using. We're producing. When you produce, you don't pay tax. When you use it or you save it, you pay tax. And it's that simple.
All right. Super good stuff. Hopefully you learned something today. I know I did, and I've been around this guy a long time. If you have not yet checked out Tax-Free Wealth, you're going to want to pick up that book. Gives you lots more ideas, including how to find a great tax professional that understands this stuff, how to realize that there are different rules, all of which are available to you. And Tom went through and updated this book at the change of the tax we had a few years back with the new Trump tax bill. So there's an update to it. So make sure you pick that up. Russell Gray, any final comments or questions for Tom?
Well, I do have some comments. I think Tom did a great job creating the explanation. And to me, you know, if I'm out there, and the reason we wanted to do this series for everybody is that there's a lot of people out there paying attention right now who are largely ignorant of the tax law, and they thought that the only way the world works is going to work, having a job, and having your taxes taken out of your paycheck, and then you just, that's the way the world works. And anybody that isn't in that system is somehow cheating. And the fact of the matter is the tax code has been designed to create the very structure for the people who are going to work and having jobs. And that's why, you know, I mean, whether you like him or not from a political point of view or personality point of view, the idea with both Ronald Reagan and with Donald Trump were to reduce taxes to create incentives to create more jobs for people. And historically, that's worked for the reasons Tom's explained. But, you know, when I'm sitting here and I'm thinking to myself as, you know, being a kid on Main Street, which I was at one point in my life, the idea of trying to become Jeff Bezos or Elon Musk or Bill Gates is like, I'm never going to become those guys. But can I go out and buy a rental property? Yeah, I can do that. Is there a way for me to be a mini Donald Trump? Not from a political point of view, not from a hairstyle point of view, not from a personality point of view, but just purely from a real estate point of view, taking advantage of what the system offers me to create a better lifestyle and to pay less tax? And the answer that I think everybody needs to hear is yes. Yes, you can do this at a small scale. It's not some evil thing. It's not some hidden thing. It is a two-tiered tax system, but it's not the way you think of it. You hear there's a tax system for the rich and a tax system for the poor. That's not what it is. There's a tax system for the educated and a tax system for the ignorant. And the ignorant pay more tax, yet they could easily cross over into the realm of education and pay less tax because, to Tom's point, the system is fair. It's available to everybody. We wanted to make the video so that people out there who don't understand this, and we've had people, multi-millionaire real estate investors, in fact, a client of Tom's. Tom, we're going to bring you back and have you do a case study with Brad because that was so powerful. And this guy was able to save huge amounts of tax. He was paying a lot of tax because even though he was a successful real estate investor, he was still ignorant of the tax code. And when he got better advice from Tom, all of a sudden it saved him a lot of money. And we're going to tell that story in great detail. But the point is that this is available to everybody. It's available to you. Pick up Tom's book, learn how to do it, get started doing it, and the world opens up for you.
So big thanks to CPA Tom Wheelwright, a great overview. We are going to continue the series with some case studies of actual properties, where the deductions were. We'll talk in detail about cost segregation, some of those things. If you're interested in more about tax, then you're going to have lots of great information, but a great place to start is Tax-Free Wealth. Thanks for watching, everybody, and we'll see you on the radio.
Before you go, 3 things. Number 1, subscribe. When you subscribe, you build up our subscription base, and that helps us reach more people. But even more important, it helps us attract great guests and subject matter experts to share their ideas and information with you. Number 2, click that notification bell to make sure that when we do post a new video on this hot topic, you're notified right away. And number 3, share. Please share this information with friends. Help them get on board this bus. Help them protect and preserve their wealth to take advantage of what's going on in the world today. All right. Thanks so much, and we'll see you in the next video.